What's up everybody, Gen X Dividend Investor here. In this video I'll share some mistakes that I've seen dividend investors make, ones that generally make me worried about their financial futures. I'll also tell you about a crazy and sad health thing that just happened to me, so I encourage you to stay until the end if you're interested in hearing about what's going on with my life. And to kick this off, I should open by saying that I'm a dividend investor who loves dividends and have found them to be the best form of passive income I've ever come across. I should also share that it took a lot of active job income over the decades to grow my portfolio to the point that it generated enough passive income to allow me to retire early, so it's not a get-rich-quick thing, but it is something that can be done. I found quality dividend stocks to be a great way to get rich slowly, and my hope is that everyone who's watching is also investing in solid companies in order to grow their asset base. Unfortunately, many people don't invest at all for a variety of reasons, and then some who do invest kind of freak me out at the way they do it. For example, dividend investors that chase high yield freak me out, especially when they don't understand the risks they face. Now to be fair, I'd say that all dividend investors chase yield to some degree, and in fact my portfolio has some fairly risky things in it that I should acknowledge. Like 13% of my portfolio is in sin stocks, which means I have a decent amount of exposure to regulatory risks along with headwinds due to the public's general trend towards becoming more health conscious. And then 11% of my portfolio is in energy stocks, an area that has its own regulatory issues along with growth concerns. 10% of my portfolio is in covered call income ETFs, which has its own risks to be aware of. So I'm definitely chasing some yield, though the majority of my portfolio is in blue chip dividend stocks that I have reasonable confidence will be able to sustain and grow as time goes on. But when a young person shares their portfolio with me and it's all high yield tickers, like all covered call ETFs, then I worry because I know that they'll probably underperform the market over the long run. Does that mean that you shouldn't invest in them at all? Not necessarily. It just depends on your goals and needs, and hopefully you understand the various trade-offs. Like it's important to acknowledge that when the market crashes, that many covered call ETFs will most likely pay out a lot less. Or maybe it's not covered call ETFs, but it's super high yield tickers that people over-index on, and high yield often means high risk. Like I saw someone who had more than 50% of their portfolio in ExxonMobil, and they got in when it was at a 5% yield. That's actually pretty nice for Exxon, but going that heavy, even in a solid stock, still freaks me out. It reminds me of a friend that lost it all when Enron went under, and it's absolutely devastating to see a 20 or 30-year employee who loses their entire 401k and more simply because they went too heavy into something they thought would keep doing well. In fact, when Enron went bankrupt, it was one of the largest corporate collapses in US history. At its peak, Enron was worth over $70 billion and was the 7th largest US company by revenue. But then after their accounting fraud and such, its stock price fell from an all-time high of $91 per share in the mid-2000s to less than $1 per share by the end of 2001. So imagine all those poor people who had large concentrations of that stock and then unfortunately see all of their wealth wiped out, which is exactly what happened to my friend. And that's why I get freaked out when I see dividend investors going all in on Exxon or whatever stock. Beyond that, the reality is that sometimes when you see a high yield, it could mean that the company's having big issues, leading to a stock price which has plummeted, which then has driven its yield sky high. Remember, the formula for dividend yield is just the amount of dividends a company pays out per share divided by its stock price. So if its stock price falls through the floor, then the dividend yield percentage shoots up. Thus, that high yield you see might mean a big problem is brewing, or it could just be people panicking and getting out. But that's why you need to be an investor who can look a bit deeper and beyond just its dividend yield to be able to assess if something is a good investment or if it's too risky. Maybe the company has an unsustainable payout ratio, which means a probable impending dividend cut. And that itself is something else that scares me. What I mean is that when I see someone's portfolio and it's loaded up with dividend payers that clearly can't sustain their dividends, then I know the investor is in for some nasty times ahead. I was actually recently looking at someone's portfolio who'd sent it to me asking for my feedback, and I saw a bunch of red flags. They held Icon Enterprises, and I wish they'd seen my video where I explained why I wouldn't invest in it. And unfortunately, Icon indeed did cut their dividend. They had a few other stocks which weren't on solid footing, and yet they unfortunately thought the dividends were basically guaranteed. But thinking that anything in finances is guaranteed is scary, because unfortunately nothing is guaranteed, not even a company that has paid out and raised its dividend for 50 plus consecutive years. I was recently chatting with someone who had taken out a loan and used that money to invest in Dividend Kings because they thought it was a guaranteed sure payout type of thing. But all you gotta do is look at history and you'll find that it's littered with previous Dividend Kings who eventually cut. Think of Leggett & Platt, a company that I used to own and a former Dividend King, which slashed its dividend from 46 cents per share per quarter down to 5 cents per share, an astonishing 89% cut. I fortunately got out of Leggett before they cut, and the takeaway is that any company can cut their divvy no matter who they are. And circling back, taking out a loan to invest in stocks is also something that worries me for a bunch of reasons. An obvious one is that stocks aren't guaranteed returns, whether we're talking about great dividend stocks or whatever. And as I've called out, any company can go under, and even a strong portfolio can go through bad times. Like, think about the last decade, which was the period between 2000 and 2009, during which the US stock market, particularly the S&P 500, produced negative real returns when adjusted for inflation. Investors who held broad stock market investments saw little to no overall gains for 10-ish years. This was due to a combination of economic crises and stock market crashes, including the dot-com bubble around 2000, the 9/11 terrorist attacks in 2001, high-profile fraud cases in Enron and WorldCom, which led to a loss of trust in financial markets, and then we had the housing market crash and global financial crisis from 2007 to 2009. So imagine how it sucked for people who saw their portfolio going down or sideways for a decade, and then imagine how that would have been even worse if you were forced to pay back a loan on stocks you took out right before everything went belly up. Part of what I learned from that lost decade was that long-term investors who stayed invested and kept contributing eventually recovered. Anyway, another reason taking on debt to buy stocks usually isn't smart is that stock prices can fluctuate unpredictably. If the market declines, your investment may lose value, but you still owe the full loan amount plus interest. Even worse is if you borrow money from a brokerage a la margin trading and the stock value drops significantly, the broker may issue a margin call requiring you to add more funds or sell assets at a loss. On top of all that, you have the stress you got to deal with regarding being further in debt. Like, if you see your portfolio drop during tough times, then you can really freak out, and you might be forced to sell stocks at a loss to cover the loan, and selling at the worst times can really put you in the hole. And if you borrow too much, then your debt anchor might force you to declare bankruptcy to break free from the chains. Bottom line, taking a loan to invest in stocks can amplify gains if your stocks move in your favor, but loans can also magnify losses and leave you in financial distress if things go south. Moving on, another thing which scares me is when someone doesn't know what they're investing in. That can range from not knowing about the company behind the ticker, to not knowing about tax implications, to not knowing about financial trends or whatever else. For example, if you hold a master limited partnership in a Roth, then you could actually end up owing taxes on it. Or maybe you aren't versed with how real estate investment trusts work, but you still invest in them. I got a note from a guy who blindly bought a REIT without understanding how to analyze it, and he freaked out and sold it when he saw that its payout ratio was super high. He had bought it without checking its metrics in the first place, which is a mistake, and then sold it by inaccurately understanding its metrics, which is another mistake. So let me explain what I mean. Pretend we have Gen X Properties REIT, and it's a real estate investment trust, aka a company that owns, operates, or finances income-producing real estate, and by law, REITs must distribute at least 90% of their taxable income to shareholders as dividends. Let's say we want to know how sustainable Gen X REIT's dividends are, and we know that for most dividend stocks that a payout ratio is a key metric investors use to evaluate sustainability. However, calculating it for REITs can be tricky, and using the wrong formula can lead to misunderstandings. So let's pretend our fake REIT made $100 million in net income for the year, and it paid $90 million in dividends, and it had $80 million in depreciation and amortization, along with $20 million of capital expenditures. It also has two other metrics that you don't normally see dividend companies talking about, and that's funds from operations, or FFO, in which they reported $180 million, and that's basically net income plus depreciation plus amortization, and then adjusted funds from operations, or AFFO, of $160 million, which is basically FFO minus CapEx. The traditional formula for payout ratio is dividends paid divided by net income, and that would yield 90%, which looks high and risky, but it doesn't really tell us what's going on with our fake REIT. But the FFO payout ratio is dividends paid divided by FFO, or 90 million divided by 180 million, which is 50%, which makes the REIT seem like a lot more sustainable. The AFFO payout ratio is even more refined, and it's dividends paid divided by AFFO, or 90 million divided by 160 million, which equals 56%. So whereas the classic payout ratio gives Gen X Properties a 90% payout ratio, which makes it seem like it's paying too much, the FFO and AFFO payout ratios show that Gen X Properties is actually comfortably covering its dividend payments with cash flow, meaning that it seems like the REIT's in a decent shape, at least from that perspective. TLDR, some investors mistakenly use the classic payout ratio formula when looking at REITs rather than using FFO or AFFO numbers, and using the wrong metrics can cause you to incorrectly evaluate the investment. Another example of not knowing about your company is not being aware of their various business trends. Do they have a history of dividend cuts? Are their earnings growing? How has the cash flow been trending? What's their debt been doing? You should be able to answer all those types of questions before you invest, and if you can't, then you might want to reconsider what you're doing. And tied to not knowing and yet still investing is when people blindly buy a stock just because someone promoted it on YouTube or on a Discord or wherever, and that scares me as well. Yes, it's great to listen to others, but you gotta research things deeply on your own. Moving on, something else which can concern me is when younger people only focus on dividend stocks, but purposefully avoid great companies that don't pay dividends. But do you really want to avoid the Amazons and the Berkshires and companies like that? Sure, you can do well only focusing on dividend stocks. 80% of the S&P 500 does pay divvies, but why limit yourself if you're not in retirement? And right now we're entering a new era of AI and robotics, and I think that younger folks should consider investing at least some of their portfolio in riskier ventures aligned with those technologies. For example, take a gander at this 15-second clip of a company called 1X that just released a neat video of their new humanoid robot.
The recent demo video shows Neo Gamma carrying a kettle of hot water, straightening a picture, carrying laundry, vacuuming, cleaning windows, picking up grocery bags, delivering a bottle of wine, tidying up, and sitting down.
My point in sharing that is to highlight that some cool new technologies will be quite profitable at some point down the road, though I also caution against going too heavy into it before it's proven. But putting a small portion of your investable assets into very risky things, including crypto, is probably worth considering as a young person. And for me, I'm talking 3 or 5% at most. But again, I'm pretty conservative. Moving on, the last couple things I want to call out that scares me about dividend investors, especially newer ones, is when they don't understand that dividends aren't free money and when they don't focus on total returns. So let's first talk about dividends not being free money, which really just means that dividends come from a company's profits, and when a company pays a dividend, it's not magically generating extra value, it's simply redistributing money that belongs to shareholders. Investors should understand that when a company pays a dividend, the stock price drops by the dividend amount, and then the market can move it up or down. Plus, when you get a dividend, there isn't really wealth creation. Like if you own a $50 stock and you get a $2 dividend, you now have a $48 stock and $2 in cash. Your total value remained the same at $50, so dividends typically don't make you richer, they just convert part of your investment into cash. However, if you reinvest your dividend, then you're owning a greater percentage of the company, though a company that is worth a tad less since it just paid out that cash. That being said, I did do a video on why dividends actually are somewhat free money, so watch that if you want a deeper understanding of things. Bottom line, dividends are valuable and are one of the key ways companies return money to shareholders, but they're not magic free money coming out of thin air, even though they honestly feel that way. And they are important enough to companies that in 2024, $630 billion in divvies were sent to shareholders, which was up 7% compared to 2023's $588 billion in payouts. That is cold, hard cash getting transferred from companies' coffers to shareholders like us, so from that perspective it does seem like free money. Moving on, something else which worries me about divvy investors is when they don't routinely reinvest their dividends. Yes, sometimes you'll have valid reasons to take that cash, but I strongly encourage you to drip when you can so that the magic of compounding can take hold as time goes on. Another scary mistake I sometimes see new dividend investors make is when they don't focus on total returns. Now, if you're in retirement and focus on dividends, then I can understand if you aren't fixated on total returns. But most young people should be focused on enabling their portfolio to grow as much as possible, which means being aware of potential stock appreciation and dividends coming in. And most people underperform the market, so just going with a broad market ETF is probably better than single stocks. Another mistake I've seen is when people let others manage their portfolios or finances without staying on top of what they're doing. Now, this example isn't specific to dividend investors, but I figured I'd still share it. For example, I work with someone who told me that they bought a bunch of different insurance products for thousands of dollars a year, even though their salary was only $50K, because their financial advisor oversold them on what was needed. But overinsuring yourself can leave you with less cash than could otherwise be used to build wealth through good investments. I'd probably temper my enthusiasm for so much insurance and instead try to max out my Roth, generally speaking, though each person's situation is unique. You gotta think though, does a younger single person really need whole life insurance if no one relies on their income? Do they need that much disability insurance? Have they built up a 3 to 6 month emergency fund first? Have they paid off their high interest debt like credit cards? Are they taking advantage of their employer 401k matches? My point is that yes, you want health insurance and auto insurance, but think carefully about life, disability, renters, etc. insurance. Of course, there are cost trade-offs with insurance where it can be better to buy before you actually need it, so lots of things to consider. But don't blindly rely on financial advisors, as they might not always do what's best for you, even if they're supposed to. And regardless, you always want to double check things and approve anything they want to do. That reminds me of a story I just saw about a famous football player named Terrell Owens, someone who earned around $80 million in his career, but now is only worth about $500,000. Apparently his big mistake was trusting in others to invest and manage his money, and that didn't turn out so well. Trusting others to manage your money is kind of what happened to my former coworker. He told me how a financial advisor convinced him to invest in annuities, even though he was only in his 20s. Annuities are financial products designed to provide income streams, typically for retirees. I'm personally not a fan of annuities for most young people for a variety of reasons. I mean, your money is generally locked up for a long time, and early withdrawals often come with hefty penalties. Plus, compared to stocks, annuities typically offer lower returns. Not just that, but some annuities come with high fees and maybe mortality expenses, all of which you might want to avoid. Now, that isn't to say that annuities never make sense. Like if you're totally terrible with money, which I bet you aren't if you're actively watching videos like this, then looking into annuities can become more compelling, at least in my opinion. And that reminds me to ask you to please leave me a comment telling me about any horror stories you've experienced, either with your investments or mistakes you've made or almost made. Okay, now I'll close things off and tell you about a crazy health thing that just happened to me, which highlights why so many people are frustrated with healthcare in the US. My longtime subscribers know that I've had multiple open heart surgeries and strokes, and yet I was the guy who was super into fitness and health for multiple decades before it all started happening. Anyway, my cardiologist recently recommended that I get an echo of my heart because it's been over 5 years since my last one, and he thought it would be prudent to see how things were going. So I reached out to my insurance to get pre-authorization, which they did. I originally talked to them on the phone and they said I was approved, but I said I wanted it in writing and they said they'd send it to me snail mail. So since they told me it was approved, I decided to get my echo, and unfortunately they found that my heart wasn't working as they hoped, and now my cardiologist needs to dive into figuring out what's going on with it and what we need to do to try to fix it. But the crazy thing that happened was that shortly after that, I got 2 physical letters in the mail on the same day, with the first one saying that my echo had been denied by my insurance because they deemed it wasn't medically necessary, and the other letter was from my insurance saying that my echo was approved, so that made no sense. The reason the first letter said I was denied coverage was because they talked to my cardiologist and he said that I wasn't experiencing any negative symptoms, but he still thought it would make sense to have a 5-year follow-up echo, but they determined that without any symptoms that meant it wasn't needed and therefore I was denied. So now I'm debating on what I should do. Do I just wait and see what the final bill looks like? Do I proactively reach out to insurance to see what the F is going on? Leave me a comment and tell me what you would do, because honestly I'm torn. And yes, both letters are for the exact same procedure and came on the same date and blah blah blah. Clearly there's a mistake somewhere, but man, it's crazy to think that I actually have a heart problem that could lead to my literal death, and had it not been approved by insurance, then I'd not have done the procedure. And that's an example of why lots of people hate the current state of US healthcare. Then to top that off, I just got some news from my best friend since elementary school that just got diagnosed with stomach cancer, and so he said his future includes chemo, and then maybe they'll have to remove his stomach and do a gastric bypass where they connect his esophagus to his intestines directly. Sorry if all that grossed you out, but maybe someone out there is dealing with their own health crap, so to you I say I can kind of relate to what you might be dealing with, and if you don't have any health stuff going on, then I want you to take a moment and reflect on how lucky you are. And with that, I'll ask you to please hit that thumbs up button, subscribe if you haven't yet, and click that bell notification. Now I'd like to pitch a few quick things, starting off with my FastGraphs affiliate link, along with my coupon code in the description of this video, as using both will allow new users to get 25% off their first payment, even if they sign up for a full year. Also check out my Seeking Alpha affiliate link, as new users often get benefits for signing up. Take a gander at my Patreon page, as sometimes I have open seats with perks you might like. And please click on that join button and become a channel member of mine, as that's an awesome way you can support me and get some cool perks along the way. Whatever you do, don't forget to join my free Dividend Discord chat server, which has over 11,000 Dividend investors on it from 85 countries around the world. Thanks for watching, stay positive, and I'll talk to you again real soon. Remember, I'm not a financial advisor and my videos are for entertainment and inspirational purposes only. Investing of any kind involves risk. I'm only sharing my opinions with no guarantee of gains or losses on investments.